Good morning, everyone. Thanks for being with us this morning on a sort of pre-lunch break panel. So our challenge is to make this conversation as exciting and interactive as possible with a very hot topic, which is how LP can navigate in the current environment, economic context, which could sound like a sort of killer combo for investment, high inflation, high interest rate, and low growth. So we've got two prominent LPs to share their views on this topic, Ellen Steers from Pantheon and Tom Massey from TMRS. To start with, I would like to ask you, because you somehow represent North American LPs and European LPs, what is your view on this economic context from both sides of the Atlantic? What's the difference, and how would you pick the characteristic of the macro dynamics?
So maybe I'll lead off here, and maybe just a quick intro. So I'm a partner at Pantheon, based in London, but I sit on our International Investment Committee, which approves all of the deals across the world. And I also sit on our Global Co-Investment Committee, which approves all the co-investments, and our European Investment Committee. So I've got a kind of an overview of what's going on. We manage about $90 billion, and that's in a mixture of all sorts of different private assets, so private equity, but also private infrastructure, private debt, and now private real estate as well. So quite a wide range of sub-asset classes. And then in terms of investors, I mean, I sit in London, but we actually work for a very wide range of investors, from sort of Asian sovereign wealth funds all the way through to US investors, from very large investors right down to endowments, foundations, family offices, and even individual investors, because we have a retail vehicle that's quoted on the London Stock Exchange. So quite a broad range. So to come to your question, Emmanuel, but I wanted to put it in context first of all. I think that LPs today, I don't see a lot of difference really between investors from all over the world. In private equity, people are looking for that additional return over public equities, and I see that all the way from sort of the east to the west. I think people have the same concerns in this environment about the macro, about inflation, about interest rates, and about, we're going to talk about it, I think, but about the balance of power between LPs and GPs. So not a great deal of difference, I think, from my point of view.
Tom, would you say there are any specifics related to the North American market?
Yeah, I mean, well, I did have the opportunity to be a part of the IPEM Limited Partnership Advisory Committee last night, and I think probably the thing most affecting LPs in the moment in terms of actually changing activity is probably interest rates. Obviously, I work for a US public plan. We operate under a static discount rate system, so things tend to operate over much longer time horizons. But talking to some of my European colleagues last night, they are kind of coping with denominator effects exacerbated by discount rate effects. So differences, probably in institutional framework. I think what came out of it were most people seem to be kind of heads down, still allocating capital, kind of trying to stick it out with relatively even allocations over time as well. So I'll kind of leave it at that.
I think that's right, and I think maybe just to add to that, institutional investors that have been around, for a long time, that have seen the effects of the last crisis, I think learnt quite a bit. There was a bit of a knee-jerk reaction after the GFC, where again the denominator effect kicked in, and people stopped investing, and they got worried about things, and I think that's a lesson learned, about sort of steady deployment.
From the previous crisis that could also apply to the current context. So you said, Ellen, but whatever the LPs is based, whatever is nature sort of thing, you have the same concern. And so you think both to say, basically, maybe we shouldn't be having this conversation at all because the macro side of things doesn't seem to weigh much in what you were saying. I mean, you could have said, oh, it's absolutely crazy, this inflation rate that we see, we are heading into a recession. You didn't have this sort of reaction. Does that mean that macro doesn't matter that much in the end?
It's a really good question, actually. I think in private equity, it's the micro which trumps the macro. So yes, of course, the macro matters in the sense that both LPs and GPs have to navigate it. But in the end, you're investing in individual assets in the companies. You're investing alongside individual general partners. And I think it's the selection which really counts, and particularly in this environment. So what I would say is that in more difficult macro environments, that dispersion of returns and dispersion of expertise between different GPs and the different performance of assets really gets accentuated. So I think it's the micro really matters, and it matters even more in a more difficult macro context.
So Tom, would you say that the pressure is more on the LP side to have this good selection rather than managing and jungling with the macro?
Yeah, no, I would agree. I think within from the LP side, kind of the private equity 10-year vehicles are disciplining, so at least it prevents us from having to rethink too many decisions. However, kind of with the broad landscape of product offerings we have out there, be they kind of operational or sourcing led or kind of specialist sectors, you know, even the betas we're investing in are really kind of at the behest of LP decisions in choosing long-term partnerships that actually make sense for that particular institution. So not to overstate kind of LP's role or understate GP's role in this perspective, but portfolio construction tends to drive what happens within your portfolio, and kind of the micro GP selections kind of enable you to scale against that problem. And that's where most of the value seems to be driven, at least as we've assessed it.
And what about your private equity allocation? We often hear, and I think a lot of people agree in this room, that it has to be steady, it has to be consistent, it has to be robust over time in order to produce the best returns. Would you say it's still true in this current context?
Yeah, I mean, absolutely. I think steady deployment is absolutely key, because otherwise you risk being pro-cyclical. So you end up putting more into the market when times are good and less when times are bad. And actually, we all know from the academic research that actually, in some ways, you ought to be sort of anti-cyclical, that you ought to actually put more money in when things are more difficult. I mean, there's been some really interesting studies done by McKinsey, by Stanford, looking at the role of private equity in recessionary times. And actually, a lot of value is added. So you have to kind of push against that tendency to be pro-cyclical and to keep those deployments going very, very steadily. And that's at both the LP end, but also the GP end. There's also a tendency for GPs to want to rush and put money out into the market when times are good.
And in reality, would you say that your firm has put more money to work over the past 12 months than over the past 24? Have you seen an acceleration in the deployment of your capital, or any of your colleagues or other firms, whatever? If you.
So I think the makeup of what we've done has changed slightly, and it does change in different parts of the cycle. So the last 12 months, I think we heard from a previous panel that deal activity has been lower, but we are still deploying good amounts of capital, but maybe in different areas.
We'll get back to that in a minute. Tom, what's your view on this need for consistency in the allocation and not moving it up and down across the cycle?
Unfortunately, Helen and I agree on too much.
Yeah, you tend to agree too much, guys.
Panel.
We need to find some items where you would disagree. That will come in a few minutes.
Yeah, that said, you know, I think our institution in particular, we've advocated for more private equity, and we've generally gotten that. So we've been on this growth path for like 7 or 8 years. It's been tremendous for the GP community, reaching out to us for allocations in the past few years. We're kind of leveling out now, and I think we're probably settling more into this steady state, try to hit the same kind of commitment level every year. Kind of another data point I kind of found interesting that came out of our advisory committee. A question I had was, you know, have any institutions kind of misstepped in the amount they've allocated, or kind of in mismodeling kind of the back end of distributions or distributions relative to flows? And you know, institutions that have been around for a very long time and said they've never really made a serious misstep in this regard. So, you know, getting to the next point, which I suspect, but kind of in the primary commitment world, distribution slow, capital calls slow, it all kind of balances out in the end.
And within this private equity or private capital allocation as a whole that we say has to be even and quite the same over time, would you be in favor of changing it towards some strategies? I mean, you can open a newspaper and you see some articles where LPs would voice their willingness to invest more in infrastructure or in private debt, given the current context. Would you say that it's a mistake, that you don't do that at your firm, or that you only move the needle a bit?
Well, we offer all of those different strategies, and we find them quite complementary, in fact. So we have clients that invest, you know, right across the board. So I think it's not either or, and often the private debt allocations come out of a sort of a fixed income sort of bucket, and infrastructure comes out of a real assets bucket. So I think it's more about actually the swing from sort of public to private, actually. And if you look at the you know, shrinking public markets, it's been very well documented, not in terms of the value of the markets, but in terms of the number of opportunities. You know, private markets have been expanding tremendously over the last 20 years, so more opportunities, and more opportunities right across the piece, from private equity to infrastructure to private debt.
So but that means that you're a little bit against the idea of there some flavor of the month when it comes to private capital strategies.
I really don't like flavors of the month or even flavors of the year. I think that we should be, you know, collectively investing behind long-term trends, long-term themes. So whether that's, you know, digitalization, automation, that's a long-term trend which is affecting all of us, and it's a multi-year trend. Whether it's aging demographics, and that has an impact on healthcare, so life sciences funds, but also buyout funds that are investing in healthcare, sustainability, energy transition, that's going to last for a long time. So I think these should be, you know, we are long-term investors, so we should be investing behind long-term trends that are not going to fluctuate, I think, in the short term.
I bet, Tom, that you're going to agree on that one as well.
I actually do have a slightly different opinion on this one. We are very private markets focused and kind of have distinct allocations for private equity, private credit, real estate, and what we call other private markets, which is really kind of real assets ex real estate. And we probably hold out private equity as distinct from those others, where the others have much more of a yield component. So where we are talking as an institution is kind of where we're putting marginal illiquid dollars to work is, hey, we might prefer private credit to real estate kind of in this context. We've kind of reorganized where kind of capital structure is much more kind of private credit focused and trying to take equity exposure in real estate and infrastructure and kind of making those trade-offs, where private equity is much more kind of return maximization, push what, you know, is risk-adjusted private equity into the definition of one of these other asset classes and keep your eye on the prize within PE.
Okay, so once we've said that and have a better understanding, or how do you picture yourself as an LP in this landscape, I would like you to tell us, where do you see the main risks for you as LPs going forward? Is this selection process that's going to be more challenging, more difficult, more costly? Where would you put your work into?
Yeah, so you know, we've really put our work into overhauling our processes to kind of shift from a framework where we have just been allocating capital to get to targets. For just a little bit of context, TMRS was probably the last large U.S. public pension to not really jump into private markets, and we hired a team back in 2016 to do that. So it's been grow for, you know, approaching a decade now, and now we're shifting into an entirely new phase where we need to rationalize manager relationships. We went from operating out of asset class team silos to kind of bringing into one team to help better rationalize manager count growth, how we're executing co-investments and other things like that. So our focus has been on internal process changes to accommodate kind of a much wider funnel probably than we had 6, 7, 8 years ago when we just got started and we're building networks.
But that's irrespective of the context. It is what happened in your backyard.
Yes.
Is it internal process that you sort of reshaping? Or would you say that what you are saying is also linked to what's happening in the world?
To some degree, it's irrespective of context. I'm here at this conference to build up our European network, which we haven't had before, and to try to bring that knowledge on the table as a possibility for execution that we really didn't focus on before, as it was just much more executing out of our backyards to some degree. So maybe it was 50 meetings for an investment before. Now it's maybe 150 meetings as an investment for a new manager now. So
more meetings, less checks.
Yes.
That's the new equation.
I think so.
What do you think of that, Hélène? Where do you see the risk selection? What do you want to put your attention on?
I'm manager selection, absolutely. I'm afraid I agree again with Tom. Dispersion of returns just widens during more difficult times. And that's probably for a very good reason. In more difficult times, you tend to see the GPs that have better expertise in terms of their operational expertise, their operational background, knowledge, resources really comes to the fore. So that value add is really important. The sector expertise is incredibly important, and real sector expertise. So we just spend a lot more time with the GPs really understanding that, because everybody says they've got operational expertise, right? Everybody
and
says
sourcing.
And sourcing, and sector, and everything else. So it's really digging into that, looking for the proof of concept, seeing what happened in the last recession, seeing what happened in COVID. So I think that is incredibly important. It's also, I would also have a word of warning about GPs that are relatively newly established, that haven't lived through more difficult times, because I think having the scars on your back, or the arrows in your back, whatever you like to call it, I think is incredibly important. This is an apprenticeship business. You have to learn by doing the deals, learn by what's happening with the companies. And we spent a lot of time going through individual case studies, going through individual deals to find out what went right, what went wrong, and what the GP critically has learned from that.
So if I sum up, because there are many questions I would like to ask you and Tom, but the time's running out. So you say, actually, people or firms that have been through cycles before. So doesn't mean that you say emerging and new teams. It could be first-time fund, but with an established teams and all the rest of it. So this is not a crisscross. You're not saying, okay. The sector expertise, you have to challenge that. I would like to hear you, Tom, on operational and sourcing capabilities. How can you assess this is robust and firms claim things that they're actually able to do?
From a process standpoint, it's probably just going really deep in reference calls, but a lot of it is also just taking a lot of meetings and understanding how other people are communicating it. You can kind of, get the BS test, have that calibration just based on taking lots and lots of meetings. I think that's probably our first calibration, and how we try to train our younger analysts is don't short circuit decisions when there's more kind of data points that can be taken. Internally we probably have a group of people that are really good empiricists that think they can kind of dig into paper data and figure things out. We probably have another group that is much more people relationship oriented, and kind of for the more senior ranks in our organizations about blending those two perspectives and not probably letting one really get control of how those manager selection decisions are happening. So I know for one, just how GPs have resourced themselves with respect to their claims, I think is probably the first thing we really start digging into.
And is there a sort of a golden rule where the bigger the firm GP is in terms of asset under management, the better is operational capabilities or sourcing capabilities is? Because he can invest in people, he can invest in IT, I don't know, he can have experts on board. Would you say it's a golden rule? It's not that easy.
Not necessarily, because there are plenty of firms out there with a lot of assets under management, but maybe not with the right people in the right places and the right expertise. So I think
that would be a very good topic for another panel.
Precisely. So I think it's very much horses for courses. I mean, we spend a lot of time in the smaller mid-market. It's actually, we underweight the top end of the market. And, you know, clearly you can't expect a mid-market firm to have the oodles of resources that you have in a very, very large firm. But you do expect those resources to be highly experienced and really well targeted to the problems at hand. I just want to come back to what Tom said about sort of the qualitative and the quantitative. I think that's really key. Private equity is both an art and a science, and I think people do get a little bit lost sometimes in the numbers. And the numbers, of course, are all backward-looking. And our biggest job is to look forward, for the next 10 or 15 years and decide how to invest that capital. So trying to get that balance right is incredibly important. And often what we're doing is, you know, we're assessing people, organizations, you know, a succession change that's going to happen maybe in 5 years' time. So it's going to be within the life of a fund, and we have to have that assessment of who the next generation is coming through, and do we believe in them?
And this higher level of selectivity that is required in this specific context, we can argue or not, does it also apply when it comes to co-investment?
Oh, absolutely. And there it's actually on two levels, because you know, we think about co-investment as having a double quality filter. So you've got the quality filter of the GP, and something like 90% of the co-investments we do are with our primary GPs. So they're already on the Pantheon platform, which is important. But then we get to exercise a second quality filter, which is the deal filter. And there, you know, clearly we're looking at the fit of the deal with GP, we're looking at, you know, valuation, pricing, and then we're looking at the actual model of the company and the investment rationale. So it's on a number of deeper levels.
And would you say that over the past, I don't know, 10, 12 months, your co-investment activity, the money you put into work for co-investment, has decreased?
So we've kept a relatively steady pace, but I would say that there's been a shift in terms of, you know, we still get a lot of deals shown to us by non-Pantheon GPs, but it's very rare that we invest in one of those deals. So our turn-down rate of the non-Pantheon GPs has been pretty high.
Tom, would you like to comment on this co-investment thing?
And probably to take up the last two questions kind of in one, you know, I think the thing for us we think about in GP selection and co-invest selection is alignment with the GP. So a bigger manager may not be better for a certain size institution because you may not be big enough to have that type of alignment. As that translates into kind of co-investment activity for us, we've been really focused on kind of what we call institutional funds 1 through 3. You know, individuals who have come out of larger shops who have been able to mitigate the business risk half of PE very quickly, or we have cause to believe can do that. Those are groups we tend to like to partner with, and we're kind of the scale institution that the check we write, it's important to them, where for, you know, the biggest publicly traded PE firms, we're probably not that important to check to them. When that comes to translating into co-investment activity, probably unlike Pantheon, we aren't as sophisticated and don't have the same level of resources. We're really fancy ourselves relationship pickers, and kind of our deal level diligence pretty much starts and stops at, is this deal core for what the GP does? And we found almost just as a monotonic rule across our portfolio, the groups we've started investing with earlier, we've been able to get alignment with, that we're an important check for, that our co-invest check size is an important size for. That's the deal flow we tend to see, and that's the deal flow we tend to get on the zero and zero economics, and that's what's been best for our institution.
And what about secondaries? Because there's a lot of understanding that many LP portfolio companies are coming to the market, given the current context and the denominator effect that you mentioned earlier. Is this a good way of doing these deals at this time?
So we think secondaries are very interesting, not just in private equity, but also in infrastructure and in private credit as well. There's a place for secondaries, I think, in a lot of portfolios because of the J-curve mitigations, the cash flow generation. So I think, again, it's something that people should be doing through the cycles. But clearly at the moment, there are opportunities, particular opportunities. We've heard in previous panels about the denominator effect, which is causing certain institutions to have to think about trimming their portfolio. But in addition to that, it's just portfolio management. So a lot of institutions just use the secondary market, which is much more robust and institutionalized itself these days, to turn over their portfolio. On top of that, you've now got the GP-led secondary opportunity, which, again, we heard about it earlier on this morning, with certain exit routes closed to GPs as a way for GPs to be able to hang on to some of their sort of trophy assets for longer that they really believe in. But I come back to the word that Tom used, which is alignment. Alignment is absolutely key in the GP-led secondaries market.
Tom?
Yeah, I mean,
More skeptic about the GP-led deals?
Yeah, no, I mean, secondaries started predominantly on the LP side, and we're an LP management tool. Now they become a GP management tool, which is, I think, in many respects, presented to LPs as a positive for them. I think where I would push back, and maybe on the Pantheons of the world too, is there is now a new set of products coming out where GPs are being motivated to sell their assets in the secondary funds, retain some great liquidity solutions for investors, and maybe picking up on, I think the founder of LGT was speaking earlier about how private equity managers tend to sell their best assets early. Where these GP-led secondaries may have been in years 7, 8, 9 before, now we're seeing them leak down into years 5 and 6. And really, what's happening, in my perspective, for LPs, and I've heard others push back on this point as well, is now you're asking LPs to make asset-level decisions, which is really, in large part, what we've paid massive management fees and carry for GPs to do. I don't know. It's the alignment piece is, I think,
it's challenged.
Yeah.
It is challenged, and there's a thin thread probably in this context. We have only like 1 minute something left. I would like to ask you in a few words. Can you tell us what makes you optimistic about this asset class, despite the context and despite the cycles? So are you optimistic or pessimistic to start with?
I would say cautiously optimistic, and that's probably always the cynic in me. I'm never going to say I'm 100% optimistic, but I do think that this environment is where private equity can make a difference. Where you have dislocation, disruption, there are private investment opportunities, and I think it's very difficult for public markets to address those opportunities, because public markets are so short-term focused and sort of sway a little bit with sentiment, whereas with private equity, you're in it for the longer term. So I would say that this is a really interesting context, environment for private equity, but you've got to be very careful about who you partner with. And so it's all about that micro decision.
Yeah, and for me, institutions are not monoliths unto themselves. They're a revolving door of people, and having worked under a number of different governance structures, I think the best thing about private markets, about 10-year vehicles, about kind of the long-term partnerships GPs and LPs set up, is that they are aligning over the timelines people should be thinking about investments on, and otherwise kind of in public markets you can be tempted to reassess things too quickly and kind of knee-jerk cause whipsaws in your portfolios that aren't good. Private equity doesn't really let you do that, unless, of course, you want to sell your LP interest at a massive discount to Pantheon. So,
thank you very much for sharing your views with so much transparency and fun, even if you tend to agree too much to my taste. But next year we'll find a topic where you could disagree upon. Thank you very much for your attention. Thank you.